Financial lessons I should have learned in school. Taxes. Welcome to Lesson 3 of our Financial Lessons tax course. In this lesson, we will learn about adjustments, deductions, and credits. According to John Maynard Keynes, the avoidance of taxes is the only intellectual pursuit that carries any reward, and I think I might agree with him. All right. So, tax avoidance versus tax evasion. Tax avoidance is encouraged by the IRS and perfectly legal. It is the use of tax law to lessen your tax liability and maximize your after-tax income. So, it is taking tax law and using everything we can find in that law to help lower the amount of taxes that you owe. And it is legal. Tax evasion, on the other hand, is illegal. It is the failure to pay or a deliberate underpayment of taxes. So this is where people are misusing tax law or circumventing it altogether. They're not even consulting the law. They're just going in and making up numbers, or they are intentionally trying to defraud the IRS to keep from paying the amount of taxes that they owe. And this is illegal. And I'm sure you guys have seen in the news at some point in your lives someone who attempted to do this and the consequences. So you definitely don't want to be doing this. You want to be working with a tax professional or using an approved tax software to go in and find as many legal deductions and credits as you can to lower your tax liability. The third consideration to be made when determining tax liability is to review and apply adjustments, deductions, and credits. These will affect your ultimate tax liability. So we will get into the definition for each one of these, what they mean, and when they are taken. So adjustments are subtracted from the total income. After adjustments are subtracted, that's when you have the adjusted gross income. We talked about this a bit in our last lecture, but we will, after this slide, get into different specific types of adjustments, specific types of deductions and credits, or those that are most common. Deductions, we know, are subtracted from the adjusted gross income. And after those deductions are subtracted, then we have the taxable income. And then the third thing here are credits, and they are subtracted from the actual tax liability and can either be refundable or non-refundable. And that's going to be important to understand the difference between the two and what that means for your tax situation. So, types of adjustments. This, of course, is not an exhaustive list, but these are some of the most common types of adjustments that I work with my individual clients. The first is an educator expenses adjustment. Currently, this is set at $250. And so another misconception, as we've talked about before, is that many times people think that if you have one of these types of adjustments, that whatever it is that you spent in that area, you're going to have returned to you, or you will be able to have that adjusted to your income. And that's simply not true. Most adjustments and deductions have a limit. For the educator expenses, currently is $250. That's how much of an adjustment you will get regardless of how much you spent as an educator on your expenses. So you're going to want to keep in mind things like this as it pertains to your specific circumstance. If you're a teacher or an educator, you're going to want to know what the educator expenses limit is year by year. and update yourself so that you know how much you're going to be able to deduct and you're not expecting something that will not materialize based on tax law. Other adjustments include contributions to an HSA or traditional IRA, tuition and student loan interest, 1/2 of your self-employment taxes that were paid if you're self-employed, self-employed health insurance premiums, and then certain alimony payments for those agreements that were created prior to 2019. And again, these are just some of the most common adjustments. When filing your taxes, there are 2 different categories of deductions that have to be chosen. You will either use the standard deduction or itemized deductions, but not both. So the standard deduction is a set amount, and it is used in over 80% of tax returns. If you are unable to itemize your deductions, perhaps you don't have any itemized deductions, or when you do itemize them, they do not exceed the standard deduction, then you will automatically take the standard deduction. You're going to take the one that gives you the most benefit, whichever one is higher, that's going to give you the greater deduction from your taxable income, from the income that you've earned. That's going to be the one you're going to want to take because it's going to lower your taxable income so that you pay ultimately less taxes. Some of the itemized deductions that people use, the most common, are medical and dental expenses. And these would be those expenses that you pay out of pocket. If the insurance company paid a portion, you cannot claim that portion. You only are looking at the portion that you paid out of pocket. Mortgage interest. If you have a mortgage and you're currently paying interest on that mortgage loan. Property taxes that you pay, charitable donations, and then sales tax. So these are some of the deductions, but there are quite a few more. I have included with this particular course a list of credits, deductions, and adjustments that you will want to review to see if you qualify for any of those. Unlike adjustments and deductions, credits are applied to your actual tax liability. Some of the types of credits include child tax credit, child and dependent care credit, earned income credit, or the adoption credit. And these, again, are some of the most popular ones, some of the ones that I work with most often with clients, but there are others. The child tax credit is applied for people who have a qualifying dependent under the age of 18. And that particular credit varies right now, currently, between $3,000 to $3,600, depending on the age of your dependent. However, we did talk about before in our mini lesson on dependents that if you have a dependent who is permanently or totally disabled, they continue to have a credit applied for them as well because you can use them as a qualifying dependent. And currently that deduction is $500 once they are over the age of 18. So, as I've said before, the numbers and the figures change year over year. So you're going to want to make sure that you're staying up to date on what the current deduction is or credit is for the item that you're looking at, because it will change. As the year progresses, you're definitely going to want to be mindful of purchases that apply to taxes and keep these together. I mentioned before that as you get your tax forms in, you're going to want to keep them in a safe place, in the same place, preferably a folder, but then also scanning those to keep them in an electronic folder in the event that you happen to lose that folder. I get a lot of clients who move from one house to another, and for some reason they have misplaced the folder. And you're not going to want to file your taxes late, and we'll talk about why. in a subsequent lesson. So the same thing applies to different receipts and documents of things throughout the tax year that you can use to lessen your tax liability. So if you are having major medical or dental work done, or you're donating to a charity, you're going to want to keep those things so that the consideration can be made to see if your itemized deductions exceed your standard deduction. And you're going to want to maintain these files for at least 5 years. I recommend at least 5 years because you just never know when you're going to need to prove something that was claimed. So in summary, tax avoidance is perfectly legal and encouraged. Applying tax law to lower your tax liability is something that you should definitely be doing or working with a professional to have done. There are 3 ways to lessen your tax liability, and we have discussed those in a bit of detail, at least enough for you to get a good understanding of adjustments, deductions, and credits. And then you're going to want to maintain and keep your tax-related receipts and statements for at least 5 years. We will talk more about some of these topics in detail as to why you want to keep those receipts and why you want to make sure that you are applying these different rules to lower your tax liability in subsequent lessons.